and welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixture of my journey and development towards financial freedom, financial independence. They will cover financial products and they will also cover topics about improving your financial well-being so you, like me, can reach your aims sometime in the future. Now let's get into this latest video. As seen in 2022 so far, the market has been somewhat turbulent. Subject is about what exactly is a recession. So the recession is obviously impending, but the definition of a recession is it's a significant decline in the general economic activity over 2 consecutive quarters. Now, if we look into the UK for the year of 2022 to date, we have the following growth figures. In January, 0.8% increase. In February, it reduced to 0.15%. And in March, there was a reduction of minus 0.1%. Who knows what will happen moving forwards? And recently, we've seen 4 interest rate rises to combat inflation. As of today, the figures are out. Inflation is at 9%. The forecast to reach double figures, but it's the highest inflation for over 40 years. We've seen obviously a big reduction in growth, in sales, through retail sales, and things will only get worse as a result of recent changes. So NI was increased at the start of the tax year. Energy prices were increased in the UK, £600 from April. Okay, people are now saying certain things like, do we heat or do we eat? But people are stopping buying so-called big ticket items. And obviously we've seen exact same scenario across in America. Rising inflation, poor earnings, poor trading figures, and the markets have obviously reacted badly during 2022. A quick overview of certain sectors. The MSCI All World Index is down 13% year to date. The S&P 500 is down 15% year to date. The Nasdaq is down 29%. The FTSE 100, quite away from the technology stocks, is only down 2%. But who knows what will happen in the coming weeks and months when things will only get worse during 2022. What do we do to combat the impending recession, rising inflation? Well, firstly, stay calm, do not panic. Markets will always go up and down, and avoid short-term noise or sentiment. The markets hate one thing, and that is fear. And uncertainty, will obviously drive prices down. Bear markets usually last a very short period and will last a lot less time in period than bull markets. Don't look at share prices or indexes every day. They will go up and down in value sporadically. But avoid market noise. Switch off from short-term market negativity and sentiment. What are your investing objectives? It may well be, what are they for the rest of this year, 2022? What are they in 3 years, 5 years, 10 years? What are your investment goals? What are your investment reasons? And remember, the market will normally return about 8% year on year since its inception. If you are concerned about an impending recession, one thing you should do first of all is create an emergency fund or increase your emergency fund. Ideally, it's money kept in a bank or building society, especially for such inconsistencies. Emergency money. You may well be £1,000. It may well be you're comfortable with 3 to 6 months salary. Whatever level you are happy with, depending on your own personal circumstances and your own risk factors, shall we say. You do not want to sell investments, shares, funds to meet your needs at short-term notice. You may well be selling at a loss. It defeats the object of investing. Not only are you losing money, but you will incur fees to sell those investments. So what we call a double whammy. A loss is only a loss on paper. It does not become a loss until you actually sell and make a decision. So the markets may be up, they may be up or down. Maybe a sea of red for the coming months, but remember it is a short-term blip. Okay, do not sell investments at a loss. Okay. Another strategy you may well make is reducing what we call expensive debt. In periods leading up to recession, interest rates will rise. So the banks or the monetary policy will put inflation up or interest rate up to combat rising inflation. So debt will ultimately become more expensive. Avoid any undue stress or financial worry. As we said, create a financial buffer. And in a recession, companies will cut back. It may well be on spending. It may well be research and development. It may well be on the number of jobs. So don't become a statistic. However, how will you cover your debts if you lose your employment or if your company doesn't give you an annual pay rise? Do you then need to come back? Do you then need to reduce your day-to-day expenses? It may well be eating out. It may well be meals. It may well be holidays. It may well be filling the car. Now petrol is so expensive. Okay, so see it as an opportunity to get your financial affairs or your debts in order. It may well be something you decided to delay, but it may now be a great opportunity to get your affairs in order while we're going through this impending financial situation. Obviously, we're all affected by rising inflation, the impending recession, but how do you combat it? Myself personally, I see it as a potential buying opportunity. I will keep investing in the market by some kind of dollar or in the UK pound cost averaging. So if prices drop, you're going to buy more shares or units in a fund for exactly the same investment price. Remember, prices will see it as recovery. See it as a great buying opportunity to buy good companies or funds at a reduced price or sale compared to their true market or their net asset values. When the COVID came in 2020, a lot of people saw it as good buying opportunity. They made very nice profits since. Okay, it will pay off in leaps and bounds in future years. As we said, the markets were hit by COVID. They would come back. They went up 30% in 2021. If you'd invested then, you would have seen a very nice, handsome profit. So you may well see it as a good buying opportunity if you've got spare cash, or if you've done your research, you've done your funds, and you may well be, you buy funds or investments at lower prices. It may well be to bring your average buying price down, or it may well be a share has lost some value. It may well be giving you a better yield, a better dividend. Recently, I've been buying shares in UK insurance companies. They've been around for years and years. They are very cash rich, they are safe, they are boring, but everybody needs insurance, whether it's life, home, car, or a lot of companies in the UK have auto enrolment pension schemes offered by big insurance companies. But some of them are offering very nice dividends of between 6 and 7%. And these dividends will all be reinvested in my portfolio, so it will increase my portfolio, but it will also recoup dividends. And remember the power of compounding. So it may well give me a dividend of £1,000 this year. Next year, it may well give me a dividend of £1,200. So remember, the dividends will increase. So see it as a buying opportunity. Buy good shares, good companies that may well be at attractive prices. You're going to hold for the next 3, 5, 10 years to meet your end game or your financial goals, whenever that may be. Now, unfortunately, shall we say, the press will sell bad news. One of the main topics in the news lately has been technology funds. Okay, poor earnings from a lot of big companies in the US, but hopefully a short-term blip. If you look at the following chart, a quick overview of one of my holdings. It's a legal and general technology fund. It's down 17% in 2022 so far. So the 5 months for this year to date. If you'd invested £1,000 on the 1st of January, it's now worth £826. Okay. But the portfolio owns 277 shares in its portfolio. It offers great diversification and it's given very attractive fees of 0.32%. So it may be a short-term blip, but if we look at the last 3 years, It's given an average return of 23.29% against a benchmark of 16.96%. Over the last 5 years, it's given an annual return, average return, of 19.72% against a benchmark of 15.259%. So I see it as a great opportunity to buy shares at a reduced price. I say it's holding 277 shares. But my plan is to hold it for the next 3 to 5 years. And hopefully the markets will recover, sentiment recover. But it's just a great example, okay, of increasing a fund I hold at a reduced rate to what I bought in initially. But it's done for diversification. It's not like I own shares in Tesla or Apple or Microsoft in one specific company. We hold across a numerous funds within the technology sector. Summary, okay, unfortunately say there is a recession coming according to all the experts, the pundits, shall we say, okay, but how do you react to it? Stay calm, don't panic, okay. It may well be you do reduce debt, it may well be, okay, you think long term, it may well be you see it as a buying opportunity, okay. Remember, what are your investment goals, what are your investment aims, and a loss is only a loss on paper until you sell it, okay. But don't beat yourself up looking at short-term markets, whether the market goes up 2 or 3% in a day. Think of it, what you're going to do for the next 6 months, 12 months, 2 to 3, 5 years. What are your investment objectives? You will get there. As I said, think of it as the power of compounding, shall we say. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.